Good afternoon, everyone, and welcome to this masterclass. Today's topic is going to be the role of due diligence in a successful transaction. And my name is Graziele, and I'll be the moderator today. But before we dive in, can you please say in the chat where you're joining us from today? And also, just a quick reminder that this session is going to last 45 minutes. And towards the end, you're going to have our Q&A. So please feel free to share your questions in the chat. And yeah, so today's topic is going to be crucial for business owners and CEOs who are navigating through acquisitions and exits. And it's my pleasure to hand over to Donovan, the CEO of Vico Advisory. And today he'll be sharing his insights and practical experience. So welcome, Dono.
Thanks, Graziele. Good morning, everyone. Thanks for joining us this morning. I appreciate you joining us, especially given the time of year. August is it's always a tricky one to get people here because schools are starting and people are coming back from holidays and things like that. So we really appreciate it. And so today's masterclass, it'll also be recorded as well, so people can look back at it if they can't make it today, which is fine. But today's masterclass is all about the role of due diligence in a successful M&A transaction. So for starters, I thought I would just introduce myself. Who am I? My name is Donald O'Sullivan. I'm CEO of Vico Advisory. I work in M&A. I advise business owners and management teams on how to navigate growth, raise capital, scale their businesses, and advise them on their exit strategies eventually. And over the past, say, 10 to 15 years, I've worked across the globe, mostly in Europe, but also further afield as well, on M&A advisory and also in private equity, acquiring and managing businesses on behalf of a family office. What I really love to do is I love to try and find solutions for people, whether that be them trying to acquire other businesses or them raising capital or trying to even solve a complex operational issue that is where a finance solution is the answer. Yeah, that's what really drives me, is to try and find solutions to people's problems. Today's agenda. So I suppose to start off, we're going to ask the question, why is due diligence important? We always enter into these online masterclasses assuming very little knowledge. We do take things very slow and try and provide people with a good kind of basic understanding of these topics to start with. Then we're going to move on to how acquirers and investors use due diligence when making their own investment decisions. This is an important rationale, or I suppose thought, to have especially if you're a founder owner who's running a business and who's potentially looking at selling your business, or if there's investors who are potentially going to join your business and there's due diligence ongoing. It's always really important to consider things from an investor's perspective. We're going to talk about different work streams that are undergone within due diligence. And we're going to talk about within those work streams, what are the key areas of focus that due diligence advisors typically look into. We then talk about how to successfully manage a due diligence exercise. So there's specific steps that we've identified over the years that have really stood to us in terms of carrying out these exercises really efficiently and really well. And on the flip side, then we're going to touch on the normal pitfalls that we see during due diligence exercises, because we've seen it all at this point. We've seen good, bad, and ugly. And I can tell you there's wide varieties of due diligence exercises that we've been involved with over the years. We're going to then touch on a recent Irish M&A transaction that fell over during due diligence. So yeah, this is a real thing that can happen. We've experienced it many times, and this example is no different. We're then going to provide you with a kind of a thought around the typical things that a due diligence checklist would cover. So these are really important in terms of getting your house in order, if this is something that you're interested in pursuing or you're currently considering, giving you a sense as to what's involved in these checklists. And so that's something that we're going to cover. And then finally, we're going to talk about how Vico Advisory supports businesses in preparing their business for sale. We're going to have a Q&A as well that Graziele is going to lead. The chat is enabled, so for anyone who wants to put their message into the chat box, leave a question there, you can do so at any stage during the presentation. So without further ado, we'll kick off. So I suppose, what is due diligence and why is it important? I think when you're certainly selling your company or taking on investment, the stages are you'd have a term sheet in place after sharing a high level amount of information with a prospective investor or acquirer of your business. you'd sign up to that term sheet, and that term sheet would detail out the fact that there would be some due diligence required. And that would take anywhere between 1 and 3 months typically to do, can be longer, can be shorter. And what it is, it's essentially, it's a period of time by which you as the seller or the company looking for investment would make your, I suppose, the information about your business completely available to a prospective investor or acquirer. And I suppose it can be therefore quite an invasive, I suppose, procedure or exercise to go through. And there's various, I suppose, reasons for due diligence. And we've listed a couple of them here. From a buyer's perspective, a lot of it is around risk mitigation. If they're going to acquire a business or invest in a business, they need to see the business warts and all. But other considerations are equally important. So from a valuation perspective, buyers will certainly look at using due diligence to form the basis of their evaluation, or to firm up, I suppose, their thesis around why they should be investing in the business and at what valuation and what terms. It helps to inform their decision making around how they would operate the business going forward. And that touches on the next point as well. From a post-merger integration perspective, due diligence is also really important to understand, okay, what plan are we going to put in place as an acquirer or an investor post-acquisition to actually make sure that either the business is well merged into our own organization, or that it's the same investment from an investor's perspective, and that, yeah, I suppose there's a plan in place there to improve the business post-acquisition. Then the final 2 points are, I suppose, due diligence is a critical exercise to go through, especially with regards to regulatory or compliance assurance. I suppose it depends on, obviously, the business that's being acquired and also the business that's acquiring. But if it's a large business, for example, it'll have quite stringent regulatory requirements typically, and both internal and external compliance requirements too, which will require a very detailed due diligence process to be carried out. And then the final point is around uncovering synergies within both the acquirer and the seller. So this is an area of real importance and real focus for an acquirer in a due diligence process. So now I just wanted to touch on how acquirers and investors use it to make their investment decisions. It's really important for a seller or a company seeking investment to consider this when they're actually undergoing a really detailed, invasive due diligence process. Because if you don't consider this, due to the invasive nature of it and due to the, I suppose, how it can become elongated and quite, I suppose, difficult at times, you can lose sight of the fact that why you're actually doing it. Because, there's a reason for it. And as you can see there, as I've touched on, it's validating the investment thesis is really important for an investment committee of a well-established or a well-structured acquirer of a business. They're entering into this transaction on the basis of certain assumptions that they've made, and they need to test those assumptions and make sure that they still ring true. That's a really important point. Identifying risks and liabilities. So every business has risks. It could be anything from operational risks to regulatory risks. Every single business has risks. And I suppose if you were acquiring a business, you would be doing likewise. You would be trying to find out what are those risks in the business and how do we mitigate against them. And if I'm honest with you, there hasn't been any transaction that we've entered into where we couldn't find a solution to a problem or to a risk that arose during a due diligence process. I suppose it's a really important step in the process to try and find those risks and come up with mitigants to solve for them. Redefining valuation in deal terms. As I said, some acquirers or investors will use due diligence as a tool by which to recut a transaction. And I suppose you should be mindful of that as a potential risk to you as a seller or a company seeking investment. That is possible. It's a risk to you. And look, I think some investors and some acquirers, if they do that with intent often enough, they do get found out typically. That's our experience. And they do have a bit of a reputation for doing so. And I suppose if you're well advised by a corporate finance advisor, they would know that and they would be able to put you or forearm you with that information. So I suppose that's something to be wary of. I suppose the majority of investors or acquirers, they won't set out to use due diligence for this purpose, but what will happen is inevitably during a transaction and during a due diligence process, there are things that may come to light that might require a recut of the deal terms. Yeah, it doesn't happen all the time, but it certainly happens more frequently than you would consider, than you would think. So that's just something to be wary of. Assessing integration feasibility is something, as I mentioned before, especially for bigger companies buying smaller companies in the same industry where I suppose there might be a lot of attritional synergies where there's just two people doing the one job, identifying those opportunities for synergies on this cost side, but also, I suppose, if it's a strategic acquisition, identifying opportunities from a revenue synergy perspective is also something that is done quite frequently during due diligence. So this is a really exciting part, I find, where either if we're working on the buy or sell side, for us to enter into conversations with that counterparty to actually figure out what might the business look like post acquisition and what can the businesses do together. I think that's a really positive part of due diligence. And then, as I said, ensuring that regulatory and compliance, legal compliance, is something that investors and acquirers use due diligence for. Yeah, so those are the things that are worth considering as a seller or a company looking for investment. I wanted to touch now on just an overview of the various different work streams that exist within due diligence. We've just included 6 or 7 kind of work streams. There can be as many as is required, but these are probably the most common due diligence work streams that we see in transactions. Starting from left. So firstly, you've got financial due diligence. This is probably, in my view, probably the most important area of due diligence because I suppose regardless of how good a piece of technology might be, if it's a software company, or regardless of how good the people are, perhaps maybe if the financials don't stack up, I don't think you really have an investable business. So what does financial due diligence encapsulate? So you would typically engage with a financial due diligence advisor who would review financial statements. So that would be both management accounts and financial statements that are publicly listed or that are submitted to the company registration office. And they would carry out typically what's called a quality of earnings report, which would assess the quality of the business's earnings, the revenue, and then they would also, I suppose, follow all the way down to EBITDA as well. Both, and that would be across the P&L. And then they would also look at various different items within the balance sheet. If it's a software company, an area of focus that we find quite a lot in due diligence is around revenue recognition and the interplay between deferred revenue and releasing that into the P&L and making sure that recognition piece is done appropriately and according to international accounting standards. But there are other things that they'll focus on: forecasts, like looking forward, not just backwards, debtors, cash flow, and the various different revenue streams that the company might have. And look, I think it's important to note that a financial due diligence exercise, while it can sometimes seem as if they're pointing the finger at you as a company, that they might be looking for holes in the business, that it's actually quite positive in the sense that they're there actually to identify risks, yes, for their client, but quite often it's helpful to you in terms of identifying, I suppose, areas of improvement for within your business. So I always find that whenever we go in on the buy side and we identify areas of risk for our clients, and we provide those, I suppose, by questions back to the sell side, like sometimes, I suppose it depends on the seller. Obviously, they can actually take that information in a really good way, or else they can take it quite personally and quite negatively. But I always find that it's just knowledge. So yeah, validating the accuracy of the reported financials and identifying liabilities or irregularities is definitely something that a financial due diligence advisor will do. Legal due diligence. So your solicitors would engage with the company in this regard, where they have to find out legally, is the company in good standing? And how they would do that is they would examine contracts. They would look at the intellectual property rights that pertain to the company. They would consider any ongoing or potential litigation. And they would look at, as I mentioned before, the regulatory compliance. And a key point and a very fundamental point is that they would actually verify ownership. And because we've actually experienced that in a transaction previously where the ownership was very difficult to ascertain, and the buyers had to come up with a solution to satisfy that requirement. And I suppose everything is possible, but I suppose that the buyers used due diligence to identify that risk. And without that, then if they hadn't actually identified that risk, then I suppose the deal could have fallen through if they had found that on signing, say, or just before signing. So I suppose that was an example of how due diligence is actually quite a positive thing. Operational due diligence is more just around, as you can imagine, it's the day-to-day functions of the business. Could be the IT systems, the infrastructure, the supply chain, and actually understanding how the business runs and what it will take to, I suppose, integrate a post-acquisition is certainly an area of focus. And sometimes it depends on the circumstance, but if it's a large transaction, then the buy side might get a third party in to do that operational due diligence. Alternatively, what we normally see is for smaller deals, it's usually members of the management team of the buy side who would carry out that operational due diligence. and work very collaboratively and collectively with, I suppose, the management team of the company that's looking to be sold. Commercial due diligence, again, similarly, depending on the scale, there might be a third party doing this work, or alternatively, if it's a small deal, it could be done in-house. But that's very much around assessing the strategic kind of position of the company, thinking about its market position, the competitive landscape, pricing, the customer base, and the growth opportunities as well that exist. So this is something that your Accentures of the world would typically do for larger deals. But again, as I mentioned, for smaller deals, it wouldn't be uncommon for this to be done in-house. But it's a really important point, because there's no point in buying a market leader in an industry that's going backwards. This is a key area of focus for buyers or investors. Tax is something that is omnipresent, because look, we all know the saying, there's only two things sure in life, death and taxes, and it's no different in M&A. So a buyer will always seek to ensure that there are no outstanding tax liabilities or compliance issues within a transaction. And this can be quite wide ranging, because there can be various different taxes, from corporation tax to CGT. That can be employees taxes, so payroll taxes, or there can be various different taxes, especially if the business that's looking to be sold has also acquired businesses as well, especially in various different jurisdictions. That can, I suppose, further complicate the tax, I suppose, due diligence that's done on the transactions. And what I would say as well is, this is something that we always experience during due diligence, where, especially for on the sell side and the buy side, are their tax advisors are seeking, I suppose, information about things that might be considered trivial. But I suppose you have to remember that there's very little materiality when it comes to tax, because of the fact that quite often you're either compliant or not. And I suppose it's important to remember that if you're selling your company and undergoing, I suppose, a due diligence process and pulling your hair out because a tax person on the buy side is acting in that way, it's because compliance to them is either black or white quite often. And then also encapsulated within that due diligence piece is considering, well, what tax structuring work is required to actually complete the transaction. So we've been involved in transactions on a global basis, where you might have American buyers, where there might be European lenders, and there might be various different subsidiaries across the globe. And it's quite often, it can be quite complex to come up with tax solutions that solve for various different interests, for the various different stakeholders involved. And that's something that, while we're not actually tax advisors ourselves, we very much enjoy working alongside tax advisors in that regard, to actually figure out a solution that'll work for all parties. And then the final one that we've included here, and again, this is just one of many, HR and cultural due diligence. Look, there's a very well known phrase that, I suppose, your people are your best assets, and we would very much agree with that. So reviewing employee contracts, compensation plans, benefits, but also, I suppose, taking time to actually interview the management team, the CEO, making sure that there's actually a good cultural fit between both parties is absolutely critical. Making sure that from a HR perspective, the business is sound, it operates well. Not only that it crosses T's and dots its I's, but also that, I suppose, that there is a good, I suppose, high performance environment within the business, and that it's well functioning and supported by a very active HR and people management side of their business. So those are the areas, those are the work streams. There's obviously, if it's a technology company, technology DD is critical, and more we're seeing an environmental, social governance as well. The key areas within each of these work streams that I've just covered there, that are typically covered by each of the various different advisors, are as follows. Due diligence perspective, they look at both historical and forward-looking financials, but from a historical perspective, it's typically the last 3 to 5 years. So that would be yearly financial statements, as well as monthly management accounts, perhaps maybe for the previous 2 to 3 years, if they're available. They would carry out that quality of earnings report, which really focuses in on revenue. So what that entails is very much around whether revenue is recurring or not. I suppose how many customers the business has. And so that what they would be looking at there is, from a diversity perspective, is there any risk from any one customer? Does it amass perhaps maybe more than 10% of revenues? They would also be looking at customer renewals. So I suppose a net revenue retention. So that's around, are your customer renewal rates on a year by year basis, are they 50%? Are they 70%? Are they 90%? And from a valuation perspective, in terms of the revenue that generates, is that 50%, 70%, 90%? What is it? Or is it even higher than 100%, which is also possible? So, because this is obviously a key area of focus, especially for software companies, where the buyer is trying to really understand, okay, starting on 1 January next year, do we have to replace 20% of our revenue, or do we have to replace 50%, or is it 5%? So that's a key area of focus. The margins and the cost structure is an area of focus, certainly that is really honed in on during financial due diligence, because obviously over the last number of years, there's been a huge focus on where venture capital were throwing money at technology companies that were just solely focused on growth at the cost of profit. Now, in the last, say, 2 years, there's been a big drive against that, whereby I suppose investors now, regardless of where at what stage they're looking to invest, they're looking at trying to identify opportunities where there's good, solid growth, but also that I suppose the P&L works out, and that that the businesses are going to be profit making in the not so distant future. Yeah, looking at the SG&A, the operating expenses of the business is a critical area of focus within financial due diligence. Debt and obligations. So if the company has debt, what are the terms and what are the obligations on the business? Working capital and cash flow. And then, as I mentioned, the forecast, the financial models. So from a legal due diligence perspective, I'm not going to go through all these, but I think, as I mentioned there, the corporate structure is very important. The ownership, what key contracts, so customers, suppliers, any litigation, IP, employment law issues, and the insurance and the claims are really important too. There can actually be sometimes a separate insurance due diligence process, whereby the buyer's insurer will actually get involved and actually identify the particulars pertaining to their insurance contracts. Operationally, yeah, it's very much around the business model scalability. So the unit economics is really important here. Do you have that right? Are you pricing things appropriately? Are you winning a custom, or are you losing it? How competitive are you against your competitors? The supply chain logistics, if there's quite a lot of logistics involved within the business, that would obviously be more so the case for, say, industrial businesses, or I suppose businesses where there's a lot of things that, where there might be physical profits, or as opposed to services or technology. Production capacity and efficiency, IT systems and infrastructure, and I suppose looking through all the company's processes and statements of practice as well, and standard operating procedures policies. Yeah. And then commercially, yeah, as I mentioned, the market position, customer base, they'll look very much into the sales pipeline, the backlog, pricing, and then market trends and growth potential. So I quite find that that's a very positive strand in particular, because it's forward looking typically, and it is quite exciting to think about what can we achieve post acquisition. The tax due diligence, tax structuring, liabilities, they'll go through all your filings and your audits, get your RAWs up to date, your compliance certificates as well. If there's any transfer pricing, if you're a multinational business, and then, as I mentioned before, your sales tax, your VAT, your payroll taxes, and other indirect taxes. Then from a HR and cultural due diligence perspective, they'll look at the org chart, make sure that it's fit for purpose, because there can be some hidden liabilities there. Say if for example, if your business is forecasting to double in the next 2 or 3 years, but your cost base isn't following suit, the question would always be, are you adequately, I suppose, prepared for that growth given your org structure, or do you need to are there any gaps that need filling? That's certainly something that we would see quite a lot. The compensation and benefits, key personnel, cultural alignment, and then all your employee policies and compliance. But yeah, like I suppose from a tech GD perspective, because I suppose every business has an element of technology, even if it's not a software business these days. So the key areas really is in those businesses I would say would be very much around recovery, data recovery, cybersecurity risks, data protection, technical debt. So whether you're using old piece of technology to power your business, what does the tech stack look like in the architecture, and how scalable is it, and how is it maintained? So those are the things that a technology due diligence workstream would focus on. We're now going to talk to you about how to actually manage a due diligence exercise successfully. So I think the key really is the starting point. It's very much around defining the objectives and the scope. So what's in and what's out at a high level, even to start off with, can be very good. Getting the right team is really important. And that's across the board. As I've mentioned there's various different advisors that are required, obviously depending on the size of the business, but the bigger the business, the more various advisors you need with specific knowledge and experience of carrying out those due diligence exercises. Creating due diligence checklists. So as I said, later on in this session, I'm going to run you through some checklists, and we have a handout as well that you'll be sent after this call or this online masterclass, where you'll see some checklists too. But it is really important to create those checklists and have them as considered as and tailored to the specific transaction. Because quite often on the sell side, sometimes we see just generic checklists come through that aren't specific to the business that we're representing, and it slows things down, and it's not a good starting point. Coordinate the Q&A process. That's really important, and I'll touch on it in a few minutes. Depending on, again, on the size of the business, but quite often we would use a piece of technology that would actually manage the due diligence process, and that piece of technology, an online data room, would have a Q&A function within it. And then the next point leads on to that. So ensuring secure and organized information sharing. So the more organized, the better for both parties in terms of how a due diligence process goes through. Setting timelines and milestones is critical because, and what we would do is we would put together a Gantt chart that on a daily basis that would encapsulate the entire 3 months, say if it's a 3-month due diligence exercise process, to ensure that both parties are fully aware of the expectations that have been set. And we can both hang our hats on, we said we would both do what we said we would do, or if things need to change, it's pretty clear we can make those changes. And then tracking risks and red flags, that's certainly something that we would always advise would be best practice in due diligence exercises, raising the hand as soon as possible, as opposed to waiting too long and for things to become too far down the line where it could have a more material impact. Maintaining communication and transparency. We like to have Wednesday morning calls between both the buy and sell side, because that, as obviously you've had Monday and Tuesday to do some work, and you'd still have the whole of Wednesday, Thursday and Friday to do more work if, say, for example, if we were falling behind for a week's expectations. So that's something that we try and do. We try and use our Wednesdays well. And then finally, control versioning and document integrity. Yeah, this is something that is really important. Like, there can be various different versions of the same document, and I suppose you want to make sure that it's only the right information that's getting through, and that also say the buy side know exactly which version is the right document, because that can lead to things getting lost in translation, which is never a good situation. Okay, I thought I'd just include a couple of due diligence IT platforms here that we've used over the past. Things like Intralinks would be or DataSite would be quite a sizable one. But there are smaller ones that we've used, ShareVault and Reduce. But I suppose the key point to take from this is that you don't necessarily need to use a software platform to actually carry out a due diligence exercise. The bigger the transaction, obviously, the more of a need there is for this. But these systems they all work pretty much the same way, and they all work very well, where they provide a good, clear view of how engaged a potential acquirer is, how often they're looking at certain documents, when they looked at them last, and they manage the Q&A process really well. So it is a really good idea to consider using one of these software platforms for your due diligence exercises. I'm going to touch on, I suppose, the normal pitfalls that we see during due diligence and why they can potentially fall over. So poor document organization or missing data is the number one thing that we see. And this is why we always say to potential clients who are looking to sell their business, engage with us in advance of running a sale process. Let us help you to get your house in order. Make sure that we have every single I dotted and T crossed from a documentation perspective, because this is the number one area that we see businesses fall down on, and it's the number one reason for due diligence processes to fall over. Delayed responses during Q&A, that's the next one that we would see. And again, this is where a good corporate finance advisor can actually assist you in making sure that things are well organized, structured, timely, and communicated well. A siloed team communication, just, I suppose, building on what I just mentioned there. Again, this is especially the case for larger transactions where there can be teams looking at specific areas of a business. And this is where, if you don't have that Wednesday call that we would use, where you're getting literally everyone on the call, and that could be 10, there could be 30, 40 people on a call, just to cover off really quickly, are there any issues? What are the red flags? If you don't do that, information can be siloed, and information might not get to where it needs to get to in time, and that can be very detrimental. Next one, overlooking integration or post-deal implications. Yeah, look, this is something that perhaps maybe a buyer who maybe it might be their first M&A transaction, or maybe they don't have a specific process for doing M&A yet, or maybe the team is a little bit lacking in M&A knowledge or experience. This is something that we sometimes see can result in deals falling, or due diligence processes not working. is where they haven't considered what the business looks like post-acquisition, or maybe they have, but not sufficiently. And I suppose then when it comes to their investment committee, if they have one, that can be a gap that some buyers can fall down on. So I suppose as a seller, I suppose it's not really there's no onus on the seller to make a buyer consider this. But I suppose it's always a good idea from a seller's perspective to raise the point and say, look, we want to do our due diligence on you, because due diligence isn't just one way, it's a two-way thing. And so the seller should always be considering, well, what will the world look like post-acquisition? How will we engage with one another? What will the combined P&L and balance sheet look like? Operationally, how are we going to work? And if you work collaboratively with the buyer in that vein, in that spirit, I suppose it's only positive for both parties. And then finally, rushing the process and missing red flags is definitely an area that we see. So due diligence takes time, and it should be given its respect, both from a buy and a sell side. And any transactions that we've seen where a due diligence process has been rushed, I'm not going to say it has resulted in the transactions falling over, but it certainly makes things a little bit more risky for both the buyer and the seller. It certainly raises more questions than it answers. Quite often, it actually costs more money to both the buyer and the seller, because either if they rush something, then they might have to have a prolonged, elongated due diligence process that they weren't expecting, or it costs both parties in the context of risks that were not identified during due diligence that subsequently come to light post acquisition, and that would be the main cost that we would see in that context. Just wanted to touch really briefly on one transaction recently that we saw in the news that fell over during due diligence, and we're only reporting what was included in the news at the time. We weren't involved in this transaction, nor do we have any inside information as to how this transaction operated. Just wanted to make that point clear. But I just thought it was interesting. The Irish Times on May 29th, 2025 did mention that the deal collapsed after William Fry's due diligence, I suppose, process obviously must have uncovered something that they weren't interested in, or some risks that they didn't, or something like that, after 5 months of entering into conversations with Eversheds. This is something that it's not limited to smaller transactions. It can be for large transactions, and it can be for, even in this context, law firms who would obviously be very au fait with how due diligence processes work on a day-to-day basis. It's part of their job. So it can happen to them even. And I suppose, just following on from that, Irish M&A, we've seen a move towards deeper due diligence processes now, especially from an IT and ESG and a regulatory perspective. And timelines, they are becoming a bit more elongated, even just from that 3 months out to 6 months potentially on occasion too. And the reason for that is given the state of play we're at from a geopolitical perspective, there's obviously interest rates have risen. I know they've stabilized relatively recently, which is good, but we are now operating in a new world, and funding costs they have gone up, and they may go up in times to come. There's more screening from an FDI perspective, especially given Trump's tariffs. And then just locally here, there are stricter CCPC, which is the competition authority, essentially, requirements to be adhered to. And I suppose that does result in the need for more due diligence to be carried out, which does on occasion slow up the execution and can potentially raise the deal attrition risk. So I suppose the key point that I'm trying to make here is that due diligence is here to stay, and it's only going one way. So it's important to learn as much as you can about it and engage positively within it. We've just included here some common due diligence deal killers in Irish transactions. Yeah, I suppose from a risk perspective, underperformance versus forecasts. Typical impact we see is a renegotiation. Sometimes it can result in a buyer withdrawing, but that's only in drastic circumstances. Poor financial or tax records, that exists definitely. And I suppose it can risk cancelling the transaction, but quite often we would see a recut of the deal terms, especially if the buyer can take a view on the state of those records. Share structures or ownership gaps. Yeah, this is certainly something that can unhinge a transaction, like a legal uncertainty. If you can't prove that you own the shares, it can be very difficult to sell those shares, obviously. So I would say that making sure that your statutory books and records, especially from a share ownership perspective, are as clean as a whistle makes an awful lot of sense. Integration, technology, or ESG gaps. We think that from our perspective, it's really just extending out the timelines or postponing a transaction, perhaps. would be the typical impact we would see there. And then finally, regulatory or financing hurdles. I think regulatory can certainly mean a deal might be more so delayed as opposed to aborted, but financing, obviously, if you can't get the financing, a deal might have to be abandoned. So I'm not going to go through each of these checklists, but we will be providing you guys with this kind of information in our handout subsequently. And again, feel free to reach out post this online masterclass if you'd like to have more information about these checklists, but because they are very detailed and this is the type of things that we typically see at every transaction. So it's certainly worth your time to even just whenever you get some spare time in your business to imagine if you were selling your business in the morning, use these checklists to actually ascertain how would you stack up? Would a buyer actually get the information they require? We've included more checklists here across different headings as well. So you can include that in your own internal assessment as well. And then there's our final lists there of various different areas too. But what I often find is by doing that exercise, it's actually a really good way of improving your business and actually filling in the gaps that might exist. So I suppose that brings us towards the end of our session. I wanted to finalize by, I suppose, giving you guys a high level of understanding around who Vico is and how we assist businesses on the M&A journey. We provide sell-side, buy-side M&A advisory. We do debt finance advisory. We do financial due diligence, and we also assist on post M&A deal integration. We are sector agnostic. I just want to make that clear. We typically work with businesses that are, I suppose, that have low capex, so people and technology related businesses. But at the same time, we've been involved with product based businesses and high capex businesses too. And in terms of the industries that we serve, we serve, as I said, all industries, but we have specific experience in the testing, inspection, certification, compliance space, healthcare technology and services, financial services and technology, and business services, and IT managed services. So without further ado, I'm going to hand you back now to Grazielli. I'm going to stop sharing my screen for a second. I'm going to get Grazielli back in play here.
Thank you, Donald. Thank you for such valuable insights you brought today. And guys, feel free to just send your questions. But I want to start with one question. It is, how often does a deal fall through during due diligence? You mentioned about William Fry. So I was actually wondering, how often does a deal fall through the due diligence process?
Yeah, good question. I would say I don't actually have any statistics on that to hand, but it would be interesting to know that. I would say that it would be probably be in like less than 20% of transactions, I would say. But at the same time, it's I suppose the reasons for those transactions falling through would be very discreet, I would say, and would be for the reasons that we discussed in this online masterclass. Typically, it would be very unusual for something else to happen that we haven't covered in this masterclass that would result in an abortion of the transaction, especially at that stage in the deal. Like, deals can fall over for various reasons, not just due diligence as well. But I would say less than 20% of transactions would fall over during due diligence.
Okay, so let's move on to the next question here. And how much should due diligence advisors cost? How are they normally remunerated?
That's $1 million question there, Grazielli. Look, I suppose it depends on the transaction, the scale of the deal, and it depends on how complex it is. Also depends on the timings required, because we've completed due diligence exercises within weeks. And obviously that takes an awful lot of more energy and resources on our side of things. And obviously that needs to be reflected in the cost structure. And then on the flip side of things, we've got involved in small transactions where I suppose there would be limited due diligence exercises carried out purely by virtue of the scale of the business. And so on the flip side, our fees would take that into account as well. So I suppose, typically speaking, I would say it can range, the remuneration structures can range from anywhere from like a day rate, like as in it can be a cost per hour or a day rate for lawyers and financial advisors, all the way to fixed fees, especially if the buyer or seller wants to mitigate their own cost in terms of M&A. And/or it can also be rolled into the entire outcome fee for a corporate finance advisor as well. It really depends on the circumstance. So sorry to be kicking the touch there a little bit, but all of the above really is my answer.
All
Geez,
right. So we have.
actually, sorry. The final thing I'll say on that though is in terms of the cost for the entire deal, due diligence should be a relatively small cost when you consider the entire deal, and it's always certainly something that needs to happen. Just want to bear that in mind. It's not an earth-shattering amount of money.
Okay, so we have one more question here, and I believe that's probably the last one because you're going over time here. And so, are you involved in the audit financials process, or another company needs to look after it? How long does it usually take?
So, are you involved in the audit of the financials process, or another company needs to look after it? How long should you take? So, if you're getting your financials audited, you need an auditor, and so they will carry that out, and that. So, I think that's slightly different to a due diligence exercise. I suppose depend. So, if your business is only of a certain scale, it may fall beneath the thresholds that are required from an Irish company law perspective to have to obtain an audit. If they're higher than that threshold, then they need an audit. And so if you need an auditor, you have to get an auditor to complete an audit of your financial statements. And how long that usually takes. So it depends again on the size of the business, because larger businesses might have auditors that would carry out what is the threshold? W- Elena, I can take this offline with you if you like, because I suppose this is a slightly different topic to that which we're discussing on this masterclass, if that's okay. And Jack, then, do you see M&A activity to decrease in the coming years due to the uncertainty caused by tariffs? Really good question. No, I don't think so. I think that M&A is going to rebound. It's been a tough year for everyone globally. It's down 30%. But I think that there will always be M&A requirements for various different reasons. Like even where tariffs are causing businesses to suffer quite substantially, there can be M&A transactions or requirements there whereby a business that's looking for a safe home or a white knight to come and actually to rescue their business can lead to M&A as well. I think we're certainly living in a new world now, Jack, where we're seeing the impacts of these tariffs really hit everyone, and it's really a reshifting and a rebalancing that's occurring globally. And I think that short term, it's having an impact on M&A. I'd like to think that over the next 1 to 3 years, it will rebound. I think we're certainly in murky waters at the moment. Yeah.
All right. And I think, as I mentioned, you're going over time. So I think I'm just want to go through a few things here with you guys before we finish it. And I'm actually leaving here the QR code. So if you want to book a free session, free appointment with Donald, so we can just take your phone, scan the code, and you're going to be able to look at his agenda. And I just have a special question. Are you following us on LinkedIn and YouTube? If not, please do, because you're very active on those channels and you share so many different insights, thought leadership. And I'm pretty sure that's going to be like a great resource for you to learn more about M&A. And again, if you want, you can just scan the codes and you're just going to you're going to be able to access our channels. And also, I hope this session was really valuable to you. And here are our next masterclasses. So the next one is next month on the 25th of September. It is going to be about building a sellable business, what acquirers look for. So please register for those sessions. I really believe you're going to be learning quite a lot, really benefiting from them. And the next one, yes, another question. Have you already signed up for our newsletter? If not, please do. Again, it's really high valued content. So I believe you're going to have so many insights, the industry updates, and this is going to be like an exclusive content for who are signed for the newsletter. So please do. And if you have any questions, suggestions, or feedback without an us, please send an email to info@vicoadvisory.com. We're going to be very happy to answer your questions. Even if you didn't get a chance to make the question during the session, but you still have a question, please just email us and we're going to be happy to answer. And I'm just going to hand over back to Donna. But thank you very much for joining us today. And I'm really looking forward to see you on the 25th of September. And
Great,
Donna?
thanks. Yeah, thanks so much, Grazielli, for that. Listen, thanks everyone for joining us today. Really appreciate it. Again, as I said, it's a tricky time of year, so thanks for your time. And all of these will be available on our YouTube channel as well, that you can have a look, and the previous ones as well that we've carried out. might be helpful to you. But do feel free to reach out if you have any questions about M&A or the due diligence process, and we'd be more than happy to assist you. Take care, have a lovely day, and we'll talk to you soon.